Hi there, it's Friday the 24th of April 2020. I'm Steve Towers. Welcome to ITB. Let's get started. There are 4 global developments to report this week in regard to the tax aspects of COVID-19. The first is that the OECD has updated its reference document, Measures Taken to Support Taxpayers, which, as the name suggests, catalogues the actions which have been taken by individual countries to relieve the pressure on taxpayers caused by the COVID-19 crisis. For a copy of the updated document, please go to our website or app. The second development is that several business groups and think tanks have called for the OECD and the Inclusive Framework to delay their work on the digitalisation project, Pillars 1 and 2, due to the COVID-19 crisis. And similarly, 10 financial associations have called on the European Commission to delay the implementation of the EU DAX 6 reporting requirements for intermediaries due to the COVID-19 crisis. For a copy of their letter to the Commission, please go to our website or app. And finally, 12 financial associations have called on both the OECD and the European Commission to remove obstacles caused by COVID-19 in order to allow cross-border portfolio investors to access withholding tax relief they are entitled to. For a copy of their letter to the OECD and the Commission, please go to our website or app. In Hong Kong, the tax authorities have issued updated guidance on advance rulings. The updated guidance includes comments on Hong Kong's obligation under BEPS Action 5 to exchange rulings with other jurisdictions. There are 4 categories of such rulings: rulings which relate to preferential regimes, unilateral APAs or other unilateral transfer pricing rulings, rulings on PE status, and rulings on related party conduit situations. For a copy of the updated guidance, please go to our website or app. In India, the government has issued an order specifying Mauritius as an eligible country for the purpose of India's foreign portfolio investor regulations. As a consequence, India's indirect share transfer rules in Section 911 should not apply to investments by non-resident investors in specified Mauritius entities, which register as Category 1 foreign portfolio investors under the regulations. For a copy of the government's order, please go to our website or app. You'll remember that Indonesia announced last month that the rate for monthly income tax instalments for companies operating in 19 specific sectors will be reduced by 30%. Well, the government has now added 11 more sectors to that list. For a copy of the government announcement, please go to our website or app. In Singapore, the government has announced 3 measures to assist listed REITs with their current cash flow challenges. Firstly, for the 2020 year, REITs will be given extra time in which to distribute 90% of their taxable income in order to qualify for tax transparency, 12 months after year end instead of 3 months after year end. Secondly, with immediate effect, the leverage limit will be raised from 45% to 50%. And thirdly, the new minimum interest coverage ratio requirement will be deferred to the 1st of January 2022. For a copy of the government's announcement, please go to our website or app. In Thailand, the Board of Investment has announced a series of measures in response to COVID-19. The measures include tax incentives for investment in the medical sector, a temporary relaxation of investment conditions, and tax incentives for investment in the management of water resources. For a copy of the BOI's announcement, please go to our website or app. The European Court of Justice has decided 2 VAT cases. The first case is a referral from Hungary. It concerns time limits on interest on VAT refunds. And the second case is a referral from the Czech Republic. It concerns a fuel transportation supply chain. For a copy of the 2 cases, please go to our website or app. In Denmark, the government has stated that the country's various measures to assist companies with the COVID-19 economic crisis will not apply to companies which are based in tax havens according to EU guidelines. I've set out here the key paragraph in the government's statement. A similar restriction has been imposed by the Polish government. For a copy of Denmark's statement, please go to our website or app. Also in Denmark, the government has postponed, due to COVID-19, Parliament's consideration of a bill which would implement the final part of the EU's ATAD directive, notably the CFC rules. This is the 3rd time that such implementation has been delayed, and it is now long overdue. It will be interesting to see whether the European Commission will commence an action in the European Court of Justice. And finally, in Denmark, the tax authorities have issued guidance on the Danish tax characterisation of a UK limited liability partnership. For a copy of the guidance, please go to our website or app. In regard to Brexit, the European Commission has issued updated guidance in regard to the VAT treatment of goods after the transition period ends, which is currently scheduled to be on the 31st of December 2020. For a copy of the updated guidance, please go to our website or app. In Estonia, as I reported in last week's ITB, e-publications will now enjoy the reduced VAT rate of 9%, the same as for printed publications. The effective date for this change has been confirmed as the 1st of May. In France, the tax authorities have issued updated guidance on tax consolidated groups. For a copy of the updated guidance, please go to our website or app. And also in France, the tax authorities have issued guidance on the tax treatment of dividends paid by a UK subsidiary to its French parent after the Brexit transition period ends, which is currently scheduled to be the 31st of December 2020. For a copy of the guidance, please go to our website or app. In response to COVID-19, Germany and Austria have entered into an agreement in regard to the taxation of cross-border workers. You'll remember that in last week's ITB, I reported that Germany had entered into similar agreements with each of the Netherlands and Luxembourg. For information on the Germany-Austria agreement, please go to our website or app. In the Netherlands, a court of appeal has decided an interesting case in regard to the remittance basis provision, Article 2.5, in the Malta-Netherlands Treaty. The taxpayer company is dual resident. It's resident in the Netherlands based on incorporation, and it's resident in Malta based on central management and control. Under the treaty, the company is a resident of both countries under the Article 4.1 definition, but the tiebreaker rule in Article 4.4 treats the company as resident in Malta based on its place of effective management. It was accepted that the taxpayer company did not have a PE in the Netherlands and did not otherwise derive taxable profits from sources in the Netherlands. In fact, the taxpayer company derived income and capital gains from sources outside both Malta and the Netherlands. Although under domestic Netherlands law, such income and capital gains would be taxable on the basis that the company is a Netherlands resident under domestic law, the effect of the tiebreaker rule in Article 4.4 of the treaty means that the income and capital gains derived from sources in third countries would be exempt from Netherlands tax, either under the Business Profits Article, Article 7, or the Capital Gains Article, Article 14. However, that's where the remittance basis provision, Article 2.5, becomes relevant, due to the fact that the income and capital gains which were derived from sources in third countries were not taxable in Malta, as they were not remitted to Malta. Article 2.5 says this: where under any provision of this agreement, income is relieved from tax in one of the states, for example, Netherlands, either in full or in part, and under the law in force in the other state, for example, Malta, a person, in respect of the said income, is subject to tax by reference to the amount thereof which is remitted to or received in that other state, Malta, and not by reference to the full amount thereof, then the relief to be allowed under this agreement in the first mentioned state, Netherlands, shall apply to so much of the income as is remitted to or received in the other state, Malta. If Article 2.5 applies in this case to cancel out the taxpayer's exemptions under Article 7 and Article 14, the taxpayer would then be subject to Netherlands tax on the income and capital gains under domestic law. The court was required to determine a number of interpretation issues in regard to Article 2.5. Let me quickly run through them. The first issue is, does Article 2.5 apply to income derived from sources in a third country? Or is it limited to income derived from sources in the Netherlands? The court held that it applies equally to income from sources in a third country and to income from sources in the Netherlands. Secondly, does Article 2.5 apply to income which is fully exempt in the Netherlands under the treaty, or is it limited to income which is subject to reduced Netherlands tax under the treaty? The court held that it applies equally to income which is fully exempt in the Netherlands under the treaty and to income which is subject to reduced Netherlands tax under the treaty. And thirdly, does Article 2.5 apply only to ordinary income, or does it also apply to capital gains? The court held that it applies to both ordinary income and capital gains. And so the court held in favour of the tax authorities. The income and capital gains were taxable in the Netherlands. For a copy of this case, please go to our website or app. Also in the Netherlands, you'll remember that the tax authorities changed their view on the VAT treatment of management and administration services which are provided to CLO issuing vehicles, from exempt to taxable at the standard rate. Well, it's been reported that the tax authorities have accepted, at least in principle, that a grandfathering period should apply to this change of view. This will be one to watch. Spain has become the latest EU member state to harmonise the VAT rate for electronic publications and their paper equivalents. Accordingly, the 4% reduced VAT rate will apply for e-publications instead of the 21% standard rate, effective from the entry into force of the Royal Decree. In Sweden, the government has proposed an expansion of the scope of the chemical tax, which applies to the manufacture or importation of electronic products and white goods. The chemical tax does not currently apply to B2C sales by non-resident suppliers, but the government proposal would expand the scope of the tax to cover such sales, effective the 1st of October 2020. And also, a committee has recommended to the government that the scope of the chemical tax be further expanded to apply to clothes and shoes, with the exception of certain protective clothing and toys, with a new tax liability effective on the 1st of July 2021. In Turkey, the tax authorities have released for public comment draft guidance on transfer pricing. The main topic is the determination of disguised profit distributions. Public comments are requested by the 1st of May. For a copy of the draft guidance, please go to our website or app. In the UK, the Upper Tribunal has decided a VAT case in regard to the Royal Opera House at Covent Garden in London. The issue in the case was whether production costs for staging operas and ballet performances, such as costumes and guest singers, could be claimed as input tax against the sales of food and champagne at the Opera House's restaurants and bars. This issue arises because the Opera House makes both exempt and taxable supplies. Its sales of performance tickets are exempt, whereas its sales of food and beverage are taxable. The tribunal applied a direct and immediate link test instead of a but-for test, and concluded that the production costs cannot be claimed as input tax against the sales of food and beverage. For a copy of this case, please go to our website or app. And also in the UK, the tax authorities have issued guidance on the VAT treatment of call-off stock arrangements between the UK and EU member states. For a copy of the guidance, please go to our website or app. In Kenya, the government has introduced into Parliament a tax law amendment bill which proposes a wide range of changes to direct and indirect taxes. Interestingly, many of the changes will increase tax revenue, at least in the short term, which is the opposite direction that many countries are currently taking. 4 items in particular caught my eye. Firstly, new withholding taxes will be imposed on outbound payments for sales promotion, advertising and marketing services, transportation of goods, but excluding air and shipping transportation, and reinsurance premiums, except for reinsurance premiums in respect of aircraft. The rate will be 20% on the gross fees, except for the reinsurance premiums, where the rate will be 5% on the gross premiums. Secondly, the rate of dividend withholding tax on outbound dividends will be increased from 10% to 15%. Also, the current exemption from withholding tax for dividends paid by special economic zone entities will be removed. That means that dividends paid by such entities will be subject to 15% dividend withholding tax. Thirdly, the bill proposes that tax depreciation rates be generally reduced, which of course will mean that tax depreciation will be claimed over longer periods. Also, the existing investment deduction claim of 150% of capital investment will be repealed. And finally, something curious in regard to corporate income tax rates. The existing general income tax rate for resident companies is 30%. The bill proposes to abolish several existing special income tax rates. Firstly, in regard to certain companies listed on the Nairobi Stock Exchange, such companies currently enjoy special rates of between 20% and 27%. And secondly, companies operating a plastics recycling plant currently enjoy a special rate of 15%. But the curious thing is that there is no reference to the President's proposal to reduce the general corporate income tax rate from 30% to 25%. Several commentators have suggested that this was an oversight in the bill. For a copy of the bill, please go to our website or app. In the Republic of the Congo, the government has issued a decree which reduces the corporate income tax rate for 2020 from 30% to 28%. In South Africa, the government has announced that due to COVID-19, two measures included in the 2020 budget will be postponed to at least the 1st of January 2022. The interest expense limitation to be set at 30% of EBITDA, and the cap on the use of carry-forward tax losses to be set at 80% of taxable income. For a copy of the government announcement, please go to our website or app. In the UAE, the Cabinet has passed a resolution which sets out a positive list of economic activities which are eligible for 100% foreign ownership in the so-called onshore sector, that is, outside the special economic zones. The positive list contains over 100 activities which are divided into three broad areas: agriculture, manufacturing, and services. Commentators have said that this move will reinforce the UAE's appeal as a regional investment hub. For a copy of the Cabinet resolution, please go to our website or app. In Canada, the Federal Court of Appeal has reversed the Tax Court of Canada's decision in the Loblaw Financial Holdings case, which concerns Canada's CFC rules. You might remember that I covered the Tax Court's decision in ITB in 2018. The case focuses on the regulated foreign bank exclusion under the CFC rules. The relevant CFC was a subsidiary incorporated in Barbados. Although the subsidiary was indeed a regulated foreign bank with the required number of employees, the tax court had held that it failed the further condition that it principally conduct business with arm's-length persons. It was that particular point on which the Federal Court of Appeal formed the opposite view. For a copy of this case, please go to our website or app. In Peru, the government has issued a supreme decree in regard to the country's indirect share transfer rules. The decree adds the discounted cash flow method as an acceptable method for determining the market value of shares. The existing rules allow only two methods to be used: the highest daily opening or closing price method and the equity value method. For a copy of the Supreme Decree, please go to our website or app. In the US, Treasury and the IRS have issued 3 sets of guidance on the tax implications of travel disruptions caused by the COVID-19 crisis. The guidance consists of Revenue Procedure 20, Revenue Procedure 27, and a series of frequently asked questions. For a copy of these 3 items of guidance, please go to our website or app. Also in the US, the IRS has announced that it is reconsidering Revenue Ruling 71533, which limits the carryback of foreign tax credits. The IRS's announcement is in Revenue Ruling 2020-8. You can obtain a copy of that ruling at our website or app. I have 2 articles for you this week. The first article is called Unlimited Adjustments, Some Reflections on Transfer Pricing, General Anti-Avoidance and Controlled Foreign Company Rules, and the Saving Clause. It's written by Georg Koffler and Isabel Verlinden, and it's published in the IBFD's Bulletin for International Taxation. This article raises a number of interesting issues. One in particular caught my attention: the relationship between Article 9.1 and Article 1.3, the so-called Saving Clause, which was introduced into the OECD Model Treaty in the 2017 edition. Let me quickly refer to their comments on this issue. Firstly, the authors discuss and endorse the so-called restrictive view of Article 9.1, that a treaty provision similar to Article 9.1 of the OECD model requires the contracting states to use its specific allocation norm, and therefore prohibits an adjustment of the profits to any amount exceeding the arm's length profit. They then discuss the interaction between Article 9.1 and Article 1.3. If one assumes that Article 9.1 has restrictive force, such a restriction on the quantity of the profits that domestic law can allocate and tax would be arguably irrelevant under a saving clause based on Article 1.3. Such a situation would arise as each of the enterprises involved in a transfer pricing issue is a resident of its contracting state, and each of those resident states is relieved from its obligation to comply with the arm's length principle when it makes primary adjustments. The concept of taxation in Article 1.3 is broad enough to cover such an understanding. By not including Article 9.1 in the exceptions to the saving clause, contracting states would take the position that this paragraph is not intended to restrict a state's right to make transfer pricing adjustments to its resident companies, whether or not those adjustments comply with the arm's length principle, or, for example, use formulary apportionment instead, as long as they comply with the non-discrimination provisions of Article 24, which are accepted from the saving clause. Legal scholarship and US courts have drawn that very conclusion. The second article is called The Transformation of International Tax. It's written by Ruth Mason and it's available on the SSRN website. For a copy of this article, please go to our website or app. This article argues that the BEPS project transformed international tax in a more fundamental way than its critics have acknowledged. The author writes, "Academics have harshly criticised BEPS, conceiving of it as a mere technical project meant to close tax loopholes. But this article disputes these conclusions, arguing that by focusing narrowly on the technical recommendations arising from BEPS, commentators have overlooked its more profound implications. BEPS both reflected and to a significant extent operationalized meaningful changes in the participants, agenda, institutions, norms, and legal instruments of international tax. And later, she writes this: the fracturing of consensus over a century-old, mostly European gentleman's agreement, and in particular, a sharpening dispute between the United States and Europe over the taxation of digital giants such as Facebook and Amazon, has prompted ongoing negotiations over the global tax split. It is unclear whether the newly more inclusive institutions of international tax are fit for the task of mediating these disputes. BEPS thus left international tax at an inflection point. Behind are a collection of isolated national tax regimes, connected on a piecemeal basis by bilateral tax treaties maintained by technocrats hailing from a small set of OECD countries. Ahead lie at least three possibilities: reversion to bilateralism as the dominant form of international tax policy making, dissolution of the international consensus paired with re-emergence of double taxation, or expansion and deepening of multilateralism. Well, that's the way it is this Friday, the 24th of April, 2020. The ITB team will be having a well-earned one-week break. We'll be back full of life on Friday, the 8th of May. Until then, I'm Steve Towers. Have a great weekend.